LNKD, LinkedIn Corp. We have a daily chart, and we're in pre-market, and it's 5:49 a.m. Pacific Standard Time. One of the things that we focus on is making a market in the options. And we have a super bull gap in play on LNKD. Okay. And they reported quarterly earnings. They came out okay. Now, here is an $85 put, MMTs. Now, this is a perfect example, just so people will know how our alert service works. It works where, see, the high yesterday was $10.80, and they're going to expire, and it's a weekly expiration. MMTs, put your bids out there and go 50 contracts at 15 cents. Hit another 50 contracts at a quarter on that opening bell on a weekly options expiration. Today's date, 2/10/2012. 1080 was a high, 940 was a low, and this is live and it's now, and there was 95 of them bought. Sure was. In fact, if you really want to take a look at the matter on a weekly expiration, I must say, daily put volume was extremely high, down here to the $65 strike. All of this money today goes bye-bye because it's a February weekly strike prices. But they were very, very bearish in my view on this side. But then again, over here, there was some bull activity too. Now, how does the bull activity in the $85 call, which is going to be right here at this price level? So let's take that $85 call now, and yesterday's low is 75 cents. What I want you to do on this one is put bids out here right now. 50 of contracts at a dime, 10 pennies, alert. MMTs. And this is going to be the call side that expires to, here we are, LinkedIn, 75 pennies. What we're going to do is that the $85 call expires today. So we're going to go ahead and hit those bids at a dime. We're also going to see what kind of premium that they steal from them on the opening bell. Okay? It doesn't matter that you have the gap as you do right here, 82.57, 76.39. So you've got that bid gap at 82.66 and the ask at 82.75. So when we get into the opening bell, we're going to see what the how this $85 call will respond live on that opening bell. We do know one thing though, as master market makers that we are, we're going to hit that bid. We're going to line that bid at a dime. Oh yeah, 10 pennies. Line it at 10 pennies. And we'll see now, they bought them, 6,000 contracts. The bull was up there at that $85 call. And then it expires today, and it's a weekly now. Now, on the flip side of the coin, we do know that you have to be very coherent and observant and very orderly in your execution behavior management. And that is placing the limit orders before, because they're very crooked in the options market. And more so than any other time of history in the derivative or options market, whatever you want to call it. Whatever you want to call it. That's what these price levels are. So we're going to see how much premium that they steal here. And once again, We're going to go back over here to the $85 put that had a mark to market. The mark to close is 9.7 ratio. And that's that $85 put. I'd like to make it clear that with that gap, they're going to steal all of the $85 put premium out. And we have lined that royal bid on that opening bell here and now on how to steal the premium from the people who steal the premium within an exchange model. And how do they do that? It's very simple. They walk away from the bid. No one's there but you. Hey, they feel you. It bounces. It's a very nice day. It's a very nice event for that. Pre-market feature, it's a special feature on this. It's a fairly new issue. They went public, their IPO. Well, you can get all the history and talk about that part later. But what you want to do is to understand where that top end exhaustion peak in the price will be. So when they run that up to the high, and what you would be looking for, MMT, on a 3-minute level is you're going to be looking for red bars like this on a 3-minute level. You're going to be looking where once you do get the volatility upside to a resistance in your MMT platform, okay, it'll tell you where that delta line is, but then that delta line, guess what happens? You get a red bar. But you have to have greater red bars. And here is a perfect example of how this stock does trade at highs at various different time frames. I drew the trend lines right here because that's the key support level. Now, granted, there are going to be other price lines in your application, and there'll be some that run across areas at tops like that. Okay, but let's take you over here now to where that gap, this is the close, and you're going to gap up into resistance now, MMTs. And within and you know that between 81.48 and 84, of course, there's going to be, just go to your application and you'll find the middle of where these markets are going to hit their first key resistance levels. Now, I just did that by freehand, but I know that there's a price right about, there's 83.11. So look at where you're at right now. You're not far from 83.11 in the middle, almost in there. So when the price it gets exhausted, you would roll over with your key half bar violation in price. It would descend in value and continue to go down in a descending value, which would also support your short until that ratio level is actually hit in the brain where the price is with the buyer, seller. Okay. On the support side, what we're going to do is we're going to see here on this particular call, it's an $80 call. Now watch this. On the $80 call, here's what you get. I'm going to put a bid out here on the $80 call because it expires today, and I'm going to line that bid right now at 35 pennies. 35 pennies for now because it's a weekly and it expires today, Friday, 2/10/2012. I'm going to line my bid on that side of the market and see how much premium that they steal on the opening bell in 31 minutes from now. Why are we always discount market makers in making markets with options at certain price levels? Is that we understand what you want to know. We do. That's why we're telling you now how they steal the prices and why you have to be careful and why you have to line that lower bid and how you have to minimize your risk, rather than being a victim potentially, is why not have the limit orders at 35 pennies right here? Last print was 270. Put that bid out there at 35 pennies. That is wholesale. So that if they take that premium and steal that premium, hey, okay with you. You're there to catch that limit order at that wholesale price. And you will have to monitor these now on each level on the opening bell. And on support levels, this $80 call, if they really steal the premium out and we pull back somewhere around 80.5 in here, and we're only a $4 gap, see, we have a pretty good sized gap going to the bid right now, 82.20 by 76.39, see. And when LinkedIn trades below 82.50, that means that the put side should get a little bit what? Weighted at its first opening print on this one. But line that bid, and we will update how to steal that premium, steal the bid within this closing print on this options expiration Friday, and why you make money. Not only that, is that your wholesale entry equals dollar cost risk management is at its very finest, because if I'm buying something down there at those price levels, so if I own 10 of these, that would have been $9,700. But if I'm buying 30, 50 of these down here at 15 or 25 cents, my risk is so minimized compared to everyone that's losing all their money in these open interest that expire here today. And they were buying heavy, but then they bought a little bit heavy over here too. And so we're going to see how they take that premium away on both sides of the market. Special options, weekly expiration model, and it would also include the options alert service. It's a new one that we have put together for people. And once again, it's a guide, and it's a guide for you to not ever be taken advantage of what you will witness here live today and live on that opening bell.